Welcome, everybody, to the latest season of the Insurance Law Workshop. Um, the so we have a great lineup this semester, and the first of which is Ken Klein, whom I'll introduce in a moment. But there are a few changes we've made this semester that are kind of logistical that are worth pointing out. One, as you'll see, we are on Zoom rather than WebEx. Hopefully that works better for you than WebEx. If you feel otherwise, please let us know. But we got some notes that expressing a preference for Zoom. The sessions, as always, will be recorded. And so keep that in mind, unless the presenter expresses a preference for it not to be recorded, in which case it won't. The audience, as you may know, is comprised of a mixed group of law professors, students, lawyers, regulators, non-lawyers. And so the goal is to present insurance law topics and research, but to present it in a way that is appealing and engaging to a diverse group of folks. And so if by virtue of your background something is new to you and you'd like it explained, that's totally fine. And what else? What am I missing, Peter?
I don't think you're missing anything. I just would add that everyone is welcome and that we want feedback about, like, if I thought Travis was going to say, if you are a potential participant, we'd love to hear from you. Like, if you've got a paper you want to talk about, we're a great venue for that and we're open to suggestions.
100%. So with that, I'm very glad to introduce Kenneth Klein, who's a professor at the California Western School of Law, and his paper, Truth and Consequences. Before I hand it off to him to present, I'm just going to advertise two things. So next week we have Yuzu Jin, and he'll be presenting a paper titled Re-examining Moral Hazard Under Inattention, New Evidence from Behavioral Data in Auto Insurance. And one more thing I'll advertise, is that we're very happy. So at the University of Connecticut School of Law, where we have the Insurance Law Center, which hosts this event, we've long had an LLM in insurance law, which is the only LLM in insurance law in the country. But we've also just introduced a graduate certificate in insurance law, which is basically the same program, but rather than 24 credits, is only 12 credits. And we think that will be appealing to a large number of lawyers who want to sort of tech up their knowledge in insurance law. And so if you or anyone you know might find that appealing, please reach out. Our first class will be enrolling in January 2026. So with that, I will hand it over to Ken.
Thank you. And hopefully I am about to correctly screen share. And the only thing I need folks to take from this slide is simply that I am happy to share my slides if anybody reaches out to me and wants them. And this slide has the link to find this paper if you want to dig deep into it. So hopefully I'm getting the function right. Great. So I had a really strange January because I spend most of my time when I'm not teaching in class, most of my professional work either researching insurance and in particular underinsurance and or helping homeowners who have lost everything in an event. And in January 7, the fire started in LA, so I was about to spend weeks of time up there working with homeowners. And 2 days later, the California Department of Insurance released to me 80,000 fire claims that actually would let me have insight into questions that I had been chasing for the better part of a decade. So that was a strange January. And what I want to do today is present to you what I learned from that data, which is going to describe to you something that you are going to immediately find fantastically counterintuitive and presumptively wrong, which is that a supermajority of homeowners in the United States want to fully and adequately insure their homes, are willing to pay for it, and think they have it. And insurance companies in that environment, you would expect, would be delighted to sell it to them because it means they're taking in maximum premium. But it turns out that the insurance companies both have access to the information that those homeowners likely are underinsured by a lot and yet don't sell them more. Because that is such an unlikely and surprising conclusion, and because we have an audience here of all sorts of different places in their knowledge, where you need to start with a basic primer on homeowners insurance. And don't feel nervous if you don't know this. I will tell you, I've given this presentation to Federal Reserve economists, to insurance regulators, to staff, and to insurance executives. And well over 9 out of 10 people in those rooms have never even read their own insurance policy, much less thought about what it means. So the following describes most of us who have home insurance. We first bought it because we were required to do so to close escrow and move into our new house or refinance. We renewed the policy annually without reflection unless our coverage was canceled or the premium spiked. If we ever shopped our insurance, we shopped it on premium, not on coverage. We have never read our policy, and if we read it, we don't much understand it. So here's a quick tour of the pertinent to wildfire, which is California's big issue, parts of your insurance policy. Coverage A is the coverage clause to rebuild your house. It can be actual cash value, which is the depreciated value of your house. A 20-year-old house is less expensive to deal with than new construction. Actual cash value coverage is never enough. It can be replacement cost value, which is the amount up to a stated limit that it will cost to rebuild your house. Or it can be guaranteed replacement cost coverage, GRC, that's whatever it costs. Coverage B is other structures, that's the other stuff around your house, the fences, the garage, etc. Coverage C is your personal property. As the insurance industry says, if you took your house and turned it upside down, it's everything that would fall out. Coverage D is additional living expenses. That is the money that you're going to incur living somewhere else while your house is repaired or replaced. Debris removal is its own thing, and then landscaping as well is its own thing. Those are your basic set of coverages. You can get two possible add-ons, and these will become very important in our conversation. The first is ERC, or extended replacement coverage. That says if your coverage A is RCV and it has a limit, which all RCV coverage does, then if the actual cost to reconstruct your home costs more, you can get what it actually costs up to an additional percentage cap of 50%, 25%, or 20, descending order of frequency that it appears. Then you can also get a coverage called building code or ordinance upgrades. This is required, by the way, in California and Colorado policies. And this is if, because of code changes in between the time that your home was originally built and now it will be reconstructed, there are things that you will have to do in reconstruction that were not original to the home as it was first built. So a typical discussion, if you even have one, about if you have enough insurance is you get a closing binder to close escrow, you got to close, so you got to go get insurance. That's one of the escrow conditions. You go to an insurance agent or insurer that you know, usually because they insure your car. You say, here's my closing binder. I need insurance. You may get some follow-up questions along these lines. What's the roof? What's the age? What's the square footage? You say, okay, here's the flyer I have. So this tells you what I know about the home. The insurer says, maybe it's important to fully insure. Here's a quote. And if you ask, is that enough? They'll say, well, we can also give you this ERC bump. You say, great, thanks. And that's the full thought you put into, is your coverage adequate? What my data shows, by the way, this is a good front end thing to understand, is the result of that is that 9 out of 10 of us have RCV coverage to rebuild our home based on an estimate of what it will cost to rebuild our home that is provided to us by the insurance company. We then have a kicker that is usually between 20% and 50% in ERC coverage. We have another kicker of 10% in building code coverage, and that's what we have, which sounds like a completely sensible way to buy insurance. Everybody seems to be doing their best. Most of us never have any reason to worry about whether it's enough because nothing ever happens, which, by the way, includes judges, legislators, and regulators, which brings us now to how all of those good intentions play out. So most of us never lose our house, but some of us do. So, for instance, in the Eaton fire, 9,400 plus structures were destroyed, another 1,000 damaged, and a non-trivial number of people died. In the Palisades fire, going on simultaneously, close to another 7,000 structures destroyed and 1,000 damaged. So the question that these losses framed in my mind, and the question I've been chasing for a long, long time, is how likely was it that these 10,000 plus homeowners who had just lost everything were going to be underinsured? If they were, then by average, on how much? Why? What was causing it? What, if anything, did this imply for the rest of the nation? And what, if anything, could be done to make the future better? Those were the questions I was hoping the data would help me answer, because I had a great data set. I had 80,000 fire claims of owner-occupied insured homes across 6 years. And that was every fire claim of any size. And if you looked at it as a matter of HO policies, it was about 98% of any fire claims anywhere in California to an owner-occupied home. And I could get it disaggregated by type of coverage, amount of coverage, incurred loss, whether the loss was coded as cat or non-cat. And that was data that I could manipulate and work with and get some insights. So you start with a premise because you have a problem, which is one of the things the data doesn't do is it doesn't identify for you whether a home was destroyed versus just damaged. But that gets helped along because CAL FIRE does that coding. And because I knew from my own experience that in a catastrophe, in a wildfire, homes were essentially up or down. There's very little in between. And the reason for that is because the home is ripping through a neighborhood. And so once a home is engaged, the fire department has to abandon that home and try to set a fire line elsewhere. So there are just very few homes that are damaged but repairable in anecdotal experience. And this CAL FIRE map, which is just a portion of Altadena, confirms that. What are color coded here are lots that CAL FIRE visited preliminarily after the Altadena fire. If it's red, it's just a totally destroyed home. Undamaged homes are black. And then yellow and green are minor damage or major damage, but repairable. So you can see this anecdotal notion of homes as a general matter in something that is a catastrophe are up or down. And so you can find in there where the break point is. And this is the sensitivity study that shows you why. What you can then do is look at side by side the ratio of incurred loss to coverage A, and you can identify the percentile where you are capturing almost exclusively total losses as opposed to a mix of total losses and profound but doable repairs. And that breakpoint comes right about 90%, which also matches up with the notion that, especially in catastrophes, a home is just either up or down. So that's how I went about identifying total losses in the absence of having access to internal insurance coding of a total loss. So what does that data then describe? Now
And
that
can I just jump in, go back one
Sure.
sec?
Yeah.
The 150 or the ones above 100%, those are people who bought some of the supplemental things that you talked about before. That's so that
No, this is simply comparing um, their incurred loss as reported by the insurance company to their coverage A in policies where we know coverage A was intended to be full. So that means that a home above 150% had an incurred loss that was more than 50% over what the insurance company had estimated would be the cost of rebuilding that home. So that is, of course, a total loss. Okay. So what does that data then lead us to? And I assumed that most of the people on this meeting were not deeply obsessed by doing empirical work or deep statistics, and thank God for that, because it's certainly not my skill set. But these are the broad conclusions that I was able to reach with some confidence. If we define underinsurance as when the available insurance coverage to rebuild a destroyed home, and this now is all in, so that it includes your ERC, if any, and your building code kicker, if any. If we define underinsurance as when the available insurance coverage to rebuild a destroyed home is less than the insured reported calculation of incurred loss, slightly over 70% of homeowners are underinsured. Now, this includes, and they are underinsured by, on average, roughly 20%. This is not just in catastrophe. This picks up one-off house fires. This picks up one-off destroyed homes. Okay, this is just everybody in America who thinks they have a fully insured home is 70% likely not to have a fully insured home by, on average, roughly 20%, whatever the mechanism of loss. Okay, catastrophes are not the problem. While amongst homes destroyed in a catastrophe, 78, basically 8 out of 10 of us are underinsured by an average of 25%. If it's not a catastrophe, 7 out of 10 of us are underinsured, and when underinsurance happens, by close to 20%. So, in other words, catastrophe doesn't make underinsurance happen, but it does make it worse. Homeowners rarely choose to underinsure. I was having this conversation before we started the call. We can look at policies that either have GRC or have RCV and have picked a kicker of ERC. And we know that those policies are homeowners who wanted full insurance, were willing to pay for it, thought they had bought it. And we know, and then we know there are some portion of the folks who just bought RCV who knew it might not be enough, but there are also some portion who thought it was enough. So we can bracket it and know, looking at the frequency of policy choices across 67,000 plus policies, that between 82.5 and 99.5% of people, the truth is probably right close to 90%, want full insurance, are willing to pay for it, think they have paid for it. In other words, they are not choosing to underinsure. And by the way, this conclusion aligns very nicely with similar work that was done on flood insurance and the choices people make in purchasing flood insurance through the NFIP. So then, what is the frequency of unintended underinsurance? In other words, among the population of people across all events, what is the frequency among the people who thought they were fully insured that they turn out to be inadequately insured? That's right around 70% and right by about 20% depth. The frequent go-to instinctive response is underinsurance is a demand surge problem. Except we know it's not a demand surge problem because coverage A limits purport to account for demand surge in the way that those calculations are made. It's built into the estimate, assuming the level of risk a home is going to face of a cat event. And ERC should account for demand surge because everyone on both the insurance side and the academic side who has come to the conclusion that they can quantify demand surge says that demand surge runs between 15 and 30% depending on the event and the year. The 90% of policies have an ERC kicker, and 98% of those policies, it's a 20% kicker. Indeed, 75% of those policies, it's a 25% or more kicker. And so, given the prevalence of both RCV policies and the ERC kicker and what we know about demand surge, then in non-cat events where there is no demand surge, we certainly shouldn't see underinsurance at all. And in cat events, we should see it only very trivially.
Can I just stop for one quick second? For the people
Sure.
that didn't read the paper,
Yeah,
By demand surge basically means if everybody needs to build their house at the same time, all the carpenters raise their raises and Home Depot charges more. Is that what you're talking about?
absolutely. That it's price spikes because of scarcity of both labor and supplies. Exactly so. Um, so we know it's not demand surge that's the heart of the problem. What does it actually seem to track back to? It tracks back to the reconstruction estimate the insurer gave at point of sale. So 9 out of 10 times, I think I messed up this slide a little bit, but we'll see how we click through. So 9 out of 10 times, the homeowner simply accepts the estimate as the base amount of their coverage. In other words, 9 out of 10 times, the you go to your, we know that if 9 out of 10 people at a minimum, they go to their insurance agent, they get an estimate, and they say, fine, that's enough insurance. And yet, because those are all the RCV policies that also have ERC, and that's 90% of policies, right? So we know that they didn't fight the estimate. They didn't try to put the coverage A limit below it or above it. They instead just took ERC. Or put another way, we don't play extra innings until we've played the full nine. There's no reason to have an ERC kicker unless your coverage A is written to the estimate. And yet, if we focus on those policies and we say how accurate is the estimate when we know with confidence that you accepted the estimate at what you were given, 84% of the time it's low, and by on average 30%. And even for non-cat losses, if you take out the cat losses, it's still low 81% of the time, and by on average 27%. So this isolates that estimate, which is being provided by the insurance company and being accepted by the consumer at face value as the heart of the problem. And that means this isn't a California problem. This is a national problem because it's the same tool used everywhere in the nation. So now let's take a pause here. This data is not perfect. There is no reporting of the coding of when it's a total loss or not. So I had to come up with a strategy to isolate those. There is no collection and reporting of those estimates. So I had to come up with a strategy of seeing those, right? There is no measurement of actual loss. What's being reported by the insurance company is incurred loss, which is a point in time report of amount paid plus amount held on reserve. And that immediately raises a question in my mind, which is the only way these numbers work is if insurance companies are routinely having a total of amount paid plus held on reserve in excess of policy limits. And I cannot understand for the life of me why an insurance company would do that. But I can tell you with some confidence that the incurred loss data is insurer reported data, and they know what the California Department is collecting it for. And so they are not intentionally going to report data that is derogatory of them. If they have leeway in good faith, they will report data that is flattering to them. So that suggests that these calculations, which are done based on insurer reported incurred loss, are actually understating the degree of the problem. So the numbers are what they are, which then brings us back to the question that I'm sure many of you have articulated in your mind, which is why would the estimate persistently be low and nobody know that? Or put another way, why wouldn't the insurance company want to sell you more and collect more premium? So that starts at the end, the explanation, which is what happens after a home is destroyed, which is that claim's going to be adjusted, meaning there's going to be a negotiation between a policyholder and an insurance company about how much money is owed. The policyholder is typically going to be represented or informed by a contractor who's saying this is what it's going to cost. So the insurance company prepares for that negotiation by providing a specialized large claim adjuster, with a sophisticated big data algorithm and database. It's called Exactimate. It's the industry standard. It takes many, many hours of training, expertise, and application to apply it to an individual house. And that adjuster is going to prepare down to number of screws and linear board feet of lumber a hypothetical contract to rebuild that house. But that number is intentionally structured to be an opening offer in a perceived negotiation between sophisticated parties. Because otherwise, if the number is intended to be accurate, every high, the contractor is going to stick out their hand and say deal. And every time that it's low, the contractor is going to, with information, negotiate it up. And on average, the insurance company will be overpaying claims. Their underwriting won't match. They're adjusting and they'll go out of business fairly quickly. So it's an opening offer designed to calculate low because that is the sensible business way to do this. But now, what happens when you buy insurance is that tool that is used to generate the estimate. The problem is you now have two parties, an agent or broker on the one hand and a homeowner on the other, who both have a lack of sophistication as to cost, have no interest in spending a lot of training time and application time in coming up with an estimate, and who both share the interest of keeping premium as low as possible, the agent in order to capture the sale. And so what happens is we take that Exactimate tool or its equivalent if you are not a vendor who has control over Exactimate, and we shortcut it. We shortcut it with asking a handful of questions about your house, and bingo, in comes the estimate of RCV. Now, what we're taking is a cost-cutting tool, cost containment tool on the back end, Exactimate, intentionally designed to come in low and dependent for whatever accuracy it can have on detail and expertise, and move it into an environment where we have none of the detail or expertise, none of the sophistication, and none of the assumed back and forth negotiation. And big shocker, it amplifies the bias and it comes in low. This should surprise, frankly, no one once they understand what's going on. So if past is prologue, this is going to lead to an enormous amount of first-party litigation by underinsured homeowners, both in LA. It's happened historically. It will happen in future events. In those lawsuits, most of the time the homeowner loses. Why? Because buried in virtually every one of the insurance policies is language like this, which is this happened to be pulled out of a Colorado policy. This is only an estimate. It may not be enough. If you have concerns, talk to us. You need to have enough, right? Well, of course, from a homeowner's point of view, that's exactly what they did. But what's going on in courts is courts are drawn to some combination of, well, I doubt that most people have inadequate insurance, but if they do, they must have chosen to. This was a contract or this was a freak outcome, and I'm going to hold you to your contract. And your contract told you it was just an estimate. They told you if you wanted more, you should ask. And so, it's really on you as the consumer that you didn't understand that it's your house. You should know what it costs to rebuild your house. And this is all you paid for. And I just pop up here some typical court holdings. These are pulled out of actual court rulings on this stuff. It usually happens at discovery when the plaintiff asks for the insurance company's own insuring. And the courts are typically don't let them get to that because they say they don't owe you a duty of care to accurately estimate future replacement costs. They told you in your contract that was on you. And having made those clear statements, it's up to you, not them, to know whether you have enough insurance. Okay? And so the problem is then that a supermajority of people who have a destroyed home do not have enough insurance to rebuild. And some of them will be able to solve that problem and some of them won't. And this impacts not just the ability of homeowners to get back home, but it also undermines homeownership in general, generational wealth building, physical and mental health outcomes correlate to whether you are in a home that you own. It affects the availability of affordable housing, even to renters, because people who would be open to building that housing cannot find adequate insurance to insure the buildings. It affects also, interestingly, according to the Fed, the general stability of financial markets, which, while it's not something I can tease out in my data, everything I know about financial instruments and insurance suggests that all of this will break differently and worse along racial lines as well. So, and of course, climate change is making everything worse. So, how might we, and I know I've already been talking too long, so I will try to wrap this up rather quickly. How might we respond to this rather bleak environment? First of all, courts could respond and should respond, right? Courts could and should abandon both the presumption that the homeowner read the policy and the presumption that the homeowner understood the policy. Any of you who have bought a new home know you don't even get the policy until weeks after you have paid for it. And there's been very recent and impressive research by Daniel Schwartz, among others, that that if you ever read your policy, the more likely, the more you think, the more confidence you have that you did understand it, the more likely that you didn't. So it would be very useful if courts abandoned the premise that we've all read our policies and understood them and should be held to them. It would also, by the way, be very useful if courts would stop thinking about insurance as an arm's length contract when it's insurance of a homeowner's home, and instead started thinking of it as this company to simultaneously gain your confidence in them and therefore capture your premium dollars while shifting or disconnecting the risk that their estimate is wrong from their responsibility for that error. So this I neglected in my last minute edits of actually deleting the preceding slide. This is those same points said in plainer English than I probably just spoke them. What could state regulators do? They could allow insurers to simply quote their estimates however the insurer wished. But by regulation, simply say, if a home's destroyed and the homeowner bought to your estimate and you are wrong and underinsuring by a predetermined percentage, perhaps 5 or 10%, that the policy is deemed reformed to be a GRC policy. That would solve the problem if reinsurers would reinsure that product. A second thing you might do is you might require insurers to disclose their estimate error rates annually, make them public facing, and then let plaintiffs' lawyers do the market regulation that plaintiffs' lawyers do when they have good information. Or a more sledgehammer solution that I think probably could work is to simply adopt Colorado's approach, which is Colorado simply requires that every RCV policy have a 50% ERC kicker. And if my data is correct, that would be enough. That would just it wouldn't eliminate underinsurance, but it would make huge dents in it. So another solution, by the way, potentially lies at Fannie Mae and Freddie Mac, which is Fannie Mae and Freddie Mac already require that every mortgage-backed security, that every mortgage that is going to go into the secondary markets have RCV insurance. They don't enforce it, but they do require it. And they do think that that is full and adequate insurance. So if they simply kept those two pieces and communicated to their lenders that it is on the lenders to annually review their portfolios and sign off that the insurance is adequate for a total loss, that would solve the problem, either because the lenders would because they would be a bag of money to solve the problem when it arose. So just a closing caveat. I always say there are three big challenges in homeowner insurance markets: affordability, availability, and adequacy. And you cannot think of any one of them in isolation. The only solution to underinsurance is more coverage, and more coverage means it's going to be more expensive. And insurers are not charities or churches. You cannot force them to write premium that is not a fair and accurate priced policy. So if you are concerned as a regulator with affordability, you cannot deal with adequacy at the level of capping premium. It has to be dealt with some kind of form of voucher or subsidy, um, not with rate regulation. So, as I say, this is highly complicated. It has been a life's mission for me. As my wife says, I work in a very lonely corner. I appreciate your attention, and I am happy to answer any questions you have.
Wonderful. Thank you so much. I have a couple, but I'm happy to take other people in the queue. So it seems like I'm new to Zoom as a as a forum for doing this. I see there's questions in the chat, and so why don't we go with those first? You can also raise your virtual hand down there in the React button,
Sure.
I think. But why don't we take Jeff Stempel's question first, and then Margaret Raymond. So Jeff, why don't you go ahead? You can just read it or say it or whatever.
For sure. How's the volume?
It's fine.
But yeah, I'd love to hear a little bit more about the Colorado experience, and at the risk of trying Peter's patience, add another question or observation. As I've always thought that this was akin to what I think is happening with the undersales of flood insurance, is nobody wants to lose a sale to the guy three doors down in the strip shopping center. So there's an incentive to say, oh, you don't live in a floodplain, you don't need flood insurance, or earthquake insurance, and whether you got a 10% deductible anyhow. And that's, I don't think, inconsistent with your theory of what the carriers are doing, but I'm wondering if some of this isn't driven by perceived competition as well, that if we don't lowball people a little bit in the introductory process, our competitors will, and we're going to lose sales. And whether there's, if you thought about that and there was a solution, love to know how Colorado got to this sort of position on it. And one last, and I'll get out. And I agree with you too on this idea of, if we think of this as an arm's length thing, that's the wrong way to think about it. On the other hand, you don't want to overestimate, and the contractor immediately takes the money and runs. But it's pretty inconsistent with this fiduciary in nature relation to say Exactimate is going to lowball you right out of the gate. And do we need a change of legal configuration along that line, along with the other things you're talking about?
Sure. So first, let's start with Colorado. We'll take these things kind of in the order in which you raised them, Jeff. By the way, good to see you. The Colorado, their experience with their new law is brand new, so we don't know yet whether it's going to be work. What happened was Colorado into essentially New Year's Eve, 21-22, had the Marshall Fire, and it was a bracing experience for them. Colorado then, among other things, tried to get a handle on their likely frequency and depth of underinsurance, and their data collection wasn't much different than in conclusions than mine was. And so they took a look at that, and they came up with this law that 50% ERC should just be built in. Now, that law took effect, if I recall, effective date January 1, 2025. And so we haven't had a major Colorado fire yet, much less rebuilds. So I'm optimistic that it will work, but it's too soon to know.
Quick follow-up. And the
Yeah.
carriers didn't descend with lobbyists to say, no, no, no?
Well, I'm going to answer that in a way that will have meaning to many of you and not meaning to many of you. That's an Amy Bach question, not a Ken Klein question. United Policyholders was deeply involved in the lobbying and drafting of that law, and I do not know what headwinds that Colorado faced, but they did adopt it. Then your second question was the incentive to capture sale. So you have gone right to the heart of it, right? We had very similar problems with adequacy, availability, and affordability in health insurance. And the ACA had a way of addressing that. And one of the ways it addressed that was through a vehicle called community pricing. And the theory of community pricing was to eliminate insurers from protecting their market position by segmenting markets into high risk pools and low risk pools, et cetera. But of course, given that in property and casualty and homeowners insurance, segmenting is allowed and is possible, an insurer has to do it, because if they don't do it and their competitors do, they have to they'll be out of business, right? They'll just be, they can't proceed. And so sort of the same thing here. We could get into the details of it, but the simple way to know that it is not economically feasible for an insurer to accurately price risk and set premium to that, and thereby capture premium dollars more than they will lose premium dollars to a cheaper competitor, is that not a single insurer does it. Right? Every single insurer has looked at the market and behaves in the exact same way. And that's all the evidence we need to know about, why that it cannot pencil out. Now, finally, the concern you expressed about take the money and run. All of my research takes a big old eraser to the reality, which is that people will cheat if given the opportunity. Right? Insurers will cheat, homeowners will cheat, contractors will cheat. This, right? But there will always be cheaters when there's this much money on the table.
Great. Okay, Margaret. Margaret, you had the next
Yeah,
spot in the
I
queue,
just
and then
want
Seema.
to, thanks. I just want to know how this interacts with the standard homeowners provision, which says if you're underinsured, under 80%, then there's a whole sort of penalty regime that hits you because you're not supposed to be underinsured. But you're talking about a vast number of people being underinsured below 80%. And I'm wondering, are the insurance companies enforcing this? How does that interact with their
Right.
that all work?
So this is the so-called coinsurance clause, and what the coinsurance clause says is, and the way it works in an RCV policy is that when the insurer presents you with an estimate of what it will cost to reconstruct your home, you cannot purchase insurance below 80% of that estimate. But that doesn't mean that the estimate itself can't be flawed. So it's a little bit of an apples and oranges problem in the way that I understand your question. That may well be a me problem, not a you problem.
Yeah, I guess what the standard policy says is if you bought less than 80%, you're going to get we're going to pay you for a depreciated property, right? You're going
right. Right. And that would be a non-compliant policy with Fannie Mae, Freddie Mac under their standards. Right. And everything I can see is that just doesn't happen.
Okay. Seema is next, and then nobody else is on the queue, so you're welcome to jump on, or I will.
Thank you. Thank you, Professor Klein, for sharing your insights. I really liked your quote in the paper when that you said that you shop for premium, not for coverage. And that actually exactly the situation is.
Yeah.
So my question is that when we are talking about the underinsurance, right? So when you mentioned about that the policyholders doesn't understand the language, but considering that insurance contract is an adhesion contract, it in other way also will go in favor of the policyholder because it is prepared by the insurance company. One way to look at is that when we are saying, when you look at the insurance policies, right? And you mentioned that these are underinsured, because I have worked in the catastrophe modeling as well. I worked in the windstorm, earthquake, and many hurricanes as well. So considering that they have a vast amount of data, based on that, and they have, even the states will have the information about the insurance claims as well, like the way you collected for the California. I'm interested. I was wondering that why don't insurance states issue something on those lines that so and so hurricane has occurred or so and so wildfire has happened and that has caused to this kind of homes which were like built like maybe like 20 years old or 10 years old or like 30 years old. These many claims have been made, and what kind of impacts were there, in the sense what coverage they have covered for. And I agree that companies like Verisk and Equicat and AIR, they have their own models, earthquake models, that they have their catastrophe models, which are based all over the for whole US, right? So the state, why don't state, because insurance comes under the state government, not the federal government. This is the authority within the state government. Why don't they come up with some kind of factors that, okay, if the national standard is coming up, like let's say showing us 20% of the 20% of 20% impact to be forecasting for the predicting in the next year for the hurricanes, but considering that our data from the past experiences, we expect this is to be this much. And why don't they release this kind of information, which will help the policyholder to understand what coverages they would be interested in, and then they can buy it. I mean, when they are going for underinsurance, and this is like, I was like very surprised that why this situation, considering that we have vast amount of data.
Sure. So there's a lot packed in there, but I'll
Yeah,
go
sorry.
through it
Yes.
as both completely and efficiently as I can. So I think implicit in that is there was a lot of thinking about hurricane in Florida as opposed to fire in California. And I will tell you the reason I isolate on fire as opposed to hurricane is because hurricane is a very complicated world where you have to think differently about something that's attributed as a wind loss versus a flood loss. And if it's a flood loss, it's going to be under NFIP, and NFIP, just for starters, caps its insurance at $250,000 a home. That's the max you can buy. And now let's just take the state of Florida, where the average construction price of a home is north of $250,000. So the entire state of Florida, to whatever extent someone holds an underinsurance policy, is almost definitionally underinsured. That's why flood isn't as good a template as fire, and that's why I primarily focus on fire. The access to the data question, the fundamental question you ask is about data. And I absolutely agree with you that there are reams of data that absolutely could answer these questions and caveats that I attach to my paper. All of that data is in the possession of the insurance companies primarily. And I do not have access to it. Believe me, I've tried. And all I can tell you is that my only ability to respond to that is therefore this. I have presented this information repetitive rooms at NAIC, and therefore to rooms that are packed full of representatives of insurers. And routinely afterwards, they come up to me and say, we think we have data that would refute what you're saying. And routinely what I have said to them is, great, I hope I'm wrong. This does not describe a world I wish to live in. Show me your data, and I will be the very first person to take the mic the next meeting and say I was wrong. And they never do. And that suggests to me something. I think that silence speaks for something. Now, their data may prove I'm wrong. I hope I'm wrong. That would be super great. The next thing you asked about was cat modeling. Cat modeling, states have had various views about cat modeling. Increasingly, states are building cat modeling into what you can apply. And I think that's the only sensible way to do this. Frankly, you have to. You and I could have a long discussion offline about the accuracy of cat modeling, because you referenced, for instance, that you think you can cat model an earthquake. And I'd love to know how someone thinks they can predict that my house will or will not have an earthquake. That would be an interesting conversation. But
I will love to.
yeah, insight into that. I don't understand it. And then the final question is, why don't states do something? I mean, they know this problem. And frankly, this is not going to be shocking to anybody. It's politics, right? The problem is that The primary driver of virtually all problems in insurance is climate change. But climate change is a politically toxic thing to discuss in a political environment. And so, regulators, every state regulator who right now is having their phone ring off the hook with complaints about rising homeowner insurance premiums and cannot respond by saying things like, well, it's between two oceans in Hurricane Alley, right? They can't say that and keep their job. They can't even say the words climate change. I think an Arizona regulator got rolled for being on the climate resiliency committee of NAIC. So they have to point to something else. And typically they point toward lawsuits and lawyers, and that they can seek to control. But Lord knows what they can't do is say it's climate change, it's resulting in you being underinsured, and therefore, to get adequate insurance, premiums are going to have to go up yet more. And that's why nothing happens at the state level, as near as I can tell. I could be wildly wrong. I know nothing about politics other than what I read in the paper.
Thank
Yeah.
you.
That's probably more than enough. Who else wants to jump in? Oh, I see Jeff Estabrook. Go ahead, Jeff.
And Sonia.
Oh, sorry, Sonia. I don't see you, but great.
I
You
raised my
first?
hand.
Okay, please. Sorry, I'm only looking at the top of my screen. All right, Sonia, I think you may have been first actually, because I saw you before. So
Okay.
go ahead, and then Jeff Estabrook.
All right. My first statement is I started my insurance career and lived most of my life in the Pasadena, Altadena area. I know that area like the back of my hand. I still have family who are homeowners out there. I have friends who lost their homes in the recent fires. So it's not something that I am talking about glittering generalities. I ran underwriting departments in Southern California. And I can tell you, as you talk about the uninsured or underinsured issue, that on Saturdays, I used to have a team of underwriters and other people in my office in the old Pasadena region calling consumers, homeowners, about their underinsured issues. And I can tell you, these individuals were called everything but a child of God. I would have to intervene on most calls where property owners would go off the deep end, no matter how well we explain to them their problems and the dilemma they face. So it's not just an insurance company problem, it's a consumer education problem, which is critical, not just in California, but across this country. Second, you are spelling Altadena wrong. It's not two words, it's one word, A-L-T-E. Dina is added on. So please correct that as a person who grew up there. That's a problem for me. The question I have for you, when you looked at the claims in the community of Altadena, many of those homes were taken over by family members. I have friends who bought their parents' homes, etc. How many of those claims had unreported improvements on the property? And where did that lead to underinsurance? Because the policy clearly states if the additions or improvements where permits are required are not done, you have no coverage.
Right. Thank you. Yeah. Thank you. I appreciate all of those remarks. And in particular, I appreciate the correction of Altadena's spelling. I spent more hours than I can count in the local assistance disaster relief center in Altadena in the immediate weeks of the fire, after the fire, and I feel that community and what it's going through quite personally. And so I certainly don't want to do anything that offends. Those folks have enough weight they're carrying without me misspelling their names. And I absolutely feel the problem. I myself lost my home to wildfire several years ago. And so I do truly understand the pain they're going through. I do not disagree with you that there is a lot of this problem where real progress can be made with consumer education. I will tell you that I think that consumer education is one of the great white whales, as you probably know yourself, in insurance. We utterly failed despite, and by we I mean with a capital W, all of us who know anything about insurance have utterly failed for decades in simply communicating to homeowners that their policy doesn't cover flood. right? It's just a very
Mhm.
simple thing. Your homeowner policy doesn't cover flood. Can't seem to get that point across no matter how hard we try in any kind of penetration, which is why I kind of throw up my hands with consumer education as a solution. But I know some things that would really help in the world of consumer education. And one of those things would be um, to not bury disclosures into the middle of an extremely lengthy, turgidly written insurance policy and assume that consumers have read it and understood it. Um, Another would be to uh, not simply say, if you read your own policy and the language about the estimate, what will not jump off the page to you is that it's an estimate and that the implications of that estimate is that if we're wrong, it's on you. And it certainly doesn't advance that conversation if what you say in the policy, and most of these policies do, is if you're worried about it being enough, call us and have a conversation because that's what the homeowner thinks they have done already. And indeed, one of the other interesting data sources I have read is the 1,500-page administrative record of California after the 2008-2009 fires in trying to get an initial insight into underinsurance. And it abandons simply trying to take stories and it tries to document the frequency of homeowners really engaging in this. And what that file finds is that homeowner after homeowner says to their insurer, I just heard about the fires last year in California. I'm worried. Do I have enough? And the agent says, yeah, you have enough. And then their home burns down. And they say, but you told me I had enough. And the response of the agent is, I don't remember saying that. Why would I say that? And then, and even if they remember saying it, they say, but then the policy said it was just an estimate. And that whether that makes sense to us or doesn't make sense to us, the courts have enforced that position. I have found that as I get older, the more I find that things I intuitively believe data shows to be wrong. My intuitions are not wildly different than yours, but the data describes what it describes. And what it describes is that 9 out of 10 homeowners in an 80,000 claim set tried to buy full and adequate insurance, indeed tried to overinsure, and they were still underinsured.
Thank you.
What does that tell you then? If, excuse me, if they
Sonia, I
try
think we need
to,
to, we're at 5 o'clock, so I think we need to excuse people and also allow those others on the queue. Ken, are you going to stick around for a little bit?
As much time, I love this stuff, so I'll stick
Okay,
around as long as
so
people want to stick around.
Then if you guys, Jeff and Francisca, are willing, let's go. Sonia, you can have one more comment and then we'll go to the next.
what does the data tell you about individuals who are underinsured who had unreported improvements on their home,
I
especially in
have no data
Altadena?
on that. I have no ability to see it, just like Altadena has, as you indicate. They have these generational homes, and these generational homes, I mean, I met these homeowners, right? They're people own these homes who could never afford to buy them today. And indeed,
Right.
many of them can't afford to insure them. So Altadena is going to have a much higher penetration of uninsureds or unreported improvements or other things than, for example, Palisades is going to have, just because of the demographic differences in those neighborhoods. I have no data on those neighborhoods yet, hoping that as their claims play out and their stories play out, that I will have data that allows me to provide insight into the very important questions that you have isolated.
Thank you.
Great. So Jeff and then Francisca.
Yeah, I just wanted to reemphasize what what Sonia just talked about in terms of what happens from the carrier side of this. I know it's easy to point fingers at the carriers and let them have it and say that they're trying to game the system or cheat. as you say, everybody does that on both sides of the transaction. And what I really want to focus on, quite frankly, is the micro transaction cost here. I mean, the transaction cost at the time of putting together the policy, under the kinds of things that you're looking for really go up a lot. And what's happened is you have very large homeowners carriers. People really don't make much money on homeowners, and there's billions of homeowner policies out there. So these are all very small transactions that all get accumulated. And as you get to the point of the transaction where you're looking at the homeowner and the insurance carrier, they're both looking for ways to try and cut that transaction cost down as much as they can. And I think what the insurer is doing is really defaulting to construction issues, meaning that they get a square footage cost of reconstruction, they put that number in there, they load it up for things like demand surge and a lot of other things, but they're looking for the quickest way to get to something like a reasonable estimate. Right.
Yep.
And then they say it's just a reasonable estimate. And if you want to go out and, get your own, then do that. And I know you have problems with where in the policy that language exists, but that's the only way the transaction can get done. And the homeowner, I'm absolutely clear, is happy with trying to do it that way. They don't ask for, their own estimate. They don't come back to review it year after year, even though everybody knows that inflation, particularly home inflation, does exist. Not only with the value, the value of the home, but also the construction cost of the home. I look at my own home. I bought it 30 years ago, and I have not touched that valuations. That's pretty dumb of me. And I work in the insurance business, right? Everybody does it because nobody wants to spend the time. And why don't they want to spend the time? For the vast majority of homeowners, it's because the chances of loss are so remote. Why am I spending my time and money doing this when I have this quickly done transaction versus the potential for a loss? Now, I do not live in a wildfire area. I don't think a lot of people in LA felt like they lived in a wildfire, or I'll be honest about that. But I don't live in Florida. I don't live coastal. But nobody does it. And they let the policies just renew year over year over year over year. And even the Sonia, who was just talking about, we tried to call people and tell them that, they've let it sit there generationally, even in some instances, running off the same old number that got set, in my case, in the 1990s.
Yep. So
and people do that, and because the transactional costs are viewed by both parties to the transaction as so high relative to the possibility of loss.
And first, let me just start by saying, Jeff, I don't disagree with a single thing you said. And to the extent you hear me as pointing the finger at insurance companies, I'm going to tell you, if you read the whole piece, I don't. What I am saying, I mean, literally the first line of the piece is, I hear tell the road to hell is paved with good intentions. I think every single party is doing something in good faith that makes sense to them. Okay? Fundamentally, the result of that is that you have a party with access to vast bodies of information, the insurance company, because they know their own portfolio experience with this estimating tool and its accuracy or inaccuracy. They know that creates risk, and they are inserting language into the policy that the risk that they are willing to live with, the responsibility if it's wrong, is being transferred to the homeowner. Now, one thing I think, disagree with is the notion that a homeowner could and should go out and get their own estimate. And I will tell you, the reason I disagree with that is for two reasons. First of all, I want you to envision going to a general contractor and saying, dude, I don't want to pay you any money to build a home. I just want you to do a workup that I can rely upon and that you'll stand behind as to what it would cost to build my home. That's going to be $2,000 to $3,000 if it's a penny. And no one's going to do that for a policy that costs less than that. The homeowner actually doesn't have access to doing their own estimate. But the second piece of that is, I had a GRC policy for 25 years, and And so, given that I am who I am and my research is what it is, when I got a quote from my insurance company that I knew was too low by 50 to 100%, I said, I want to buy twice that. And they said, underwriting won't let us do that because of moral hazard concerns, unless you can document that our estimate is low. And so I slid my paper across, and they said, nope, not good enough. You have to document that your house in particular, the estimate is too low. And so I did go out and get an estimate because I knew who I could call that would cost me less than $3,000. And now I have adequate insurance. But that is not information accessible to almost anyone else on this call. So then the updating, I will tell you that it is not lost on Cotality or Verisk what you're saying about updating. And so they make it very simple. Literally, the push of a single button will update that policy for localized materials. And the insurance companies in many states, California being one of them, are actually required to do it. And they typically don't because they're worried about losing the customer. So I hope that's covered quickly because I know there are other people who want to have part of this conversation. But largely, yeah, you're absolutely right that nobody sees it in their financial interest to get this right. But
Yeah, it's the transaction
therefore,
costs that are killing them
I
off.
agree. But therefore, my response to that is it's either up to regulators to impose a solution that the market doesn't want, but will allow an insurer to insure adequately at a price where they can make a profit, or it is the responsibility of courts to not disc party who has control over the error rate, who holds the bag if there's an error.
Okay, we have one more person in the queue, and that's Francisca. So please go ahead.
Hello, good evening from London. And Professor Klein, many thanks for this very interesting presentation and congratulations on your paper. As for solutions, in the UK, home policies often have so-called basis of settlement clauses, which provide for reinstatement. Basically, that means that the that the insurer doesn't hand over cash. They actually undertake for the house to be rebuilt at whatever the costs. And this strikes me could be a solution to the problem. So I was wondering whether these clauses ever occur or are common in the US. And then my second question was why the mortgage banks are not more concerned about underinsured properties.
So, as to the first question, I believe what you're describing is a GRC policy. And increasingly, because insurers are not carrying their own risk, but rather are reinsuring, they cannot find reinsurance at a premium that they can afford. I'm going to circle back to that in a moment. For GRC, if the house is in a potential likelihood of a total loss. So you can still get a GRC policy, I believe, in Indiana, but you cannot get it unless you have a legacy policy. No one sells it as a new. The problem is that insurance is a regulated product, and you cannot increase your primary revenue stream premium without a rate filing that is approved. But your most significant cost line, which is often reinsurance, is not regulated. And so a reinsurer can be very nimble in raising reinsurance rates to primary insurers in response to, for instance, a California wildfire year or a. But the insurer cannot raise premium to cover the same thing. And so because of that, it's very difficult for an insurer to be able to reinsure a GRC portfolio in a place that has any kind of significant experience with total loss. I think I've lost track of your second question at this point, and I apologize.
Why mortgage banks are not more concerned about underinsured properties, and why they haven't sort of intervened and or sort of caught onto that problem.
Yeah. So to some degree, it is because the mortgage banks live primarily in the environment of GSEs and Fannie Mae and Freddie Mac, and that's almost all mortgages in the United States. It's well north of 90% of mortgages in the United States are Fannie Mae or Freddie Mac mortgages, and a third of those mortgages or less are held by the originating lender. The rest are sliced and diced and go off into the derivative markets. And so, as a general matter, the mortgage servicer is precisely that, a servicer. And so they are not really holding the risk. And then this dovetails all the way back to the immediate preceding questioner, which is, you know, across that portfolio, they're not going to see a lot of total losses. So they're not highly motivated to do it. And then the other piece of it is only very, very recently that the Federal Reserve and similarly qualified economists have come to the conclusion that from the mortgage lender's point of view, there is an actual downside consequence to paying off the mortgage with insurance proceeds as opposed to rebuilding the collateral. Now, the Federal Reserve has now come to the conclusion that those are not same from the position of the bank, that the bank should want the collateral rebuilt. But that is an insight that isn't, the ink isn't even dry 12 months on it.
Okay, well, I have a million questions, but I don't want to keep everybody here. And so, Ken, I'll raise those with you offline. Just please join me in thanking Ken for a fabulous presentation, a really interesting paper to start off our year, and come back in 2 weeks for more. Thanks,
Thank
everybody.
you. This was a real pleasure.